Markets started the week cautiously as Iran tensions escalated and big tech earnings loom large. The S&P 500 just closed lower by 0.2%. Energy led all sectors on rising oil prices. Chip stocks bounced back, and the VIX held at 18.6. Welcome to Invest from Zero, your daily U.S. market wrap. I'm here every single trading day to break down what happened, why it matters, and what you should be watching next. It's Monday, July 20th, and we have a packed show today. Here's what's coming up. We'll start with a deep dive into the S&P 500, then move to the NASDAQ and the Dow. After that, we'll walk through all 11 sectors one by one, so you can see exactly where the money is flowing. Then we'll spotlight the biggest individual stock movers in the megacap space, both gainers and losers, with our stock of the day getting a full 30-day chart review. We'll check in on a macro dashboard that means VIX, Treasury yields, gold, and oil. And we'll close with 3 specific things to watch before tomorrow's opening bell. If you're new here, this is the show that covers the U.S. stock market every single trading day. No fluff, no hype, just data, analysis, and context. Hit subscribe so you don't miss an episode. Let's get into it. Let's start with the benchmark, the S&P 500. Today, the index closed at 7,443.28. That's lower by 0.19%, or roughly 14 points on the day. Yesterday's close was 7,457.69, so we're looking at a slight pullback. The main overhang today was geopolitical. The United States completed its 9th consecutive day of military strikes on Iran, and oil prices pushed higher in response. Houthi rebels in Yemen also announced a maritime embargo on Saudi Arabia, adding another layer of uncertainty. On a more positive note, Iranian Foreign Ministry spokesman Esmail Baghaei raised hopes for a diplomatic settlement, which helped markets recover from their morning lows. For the week so far, the S&P is down about 1.3%. But the real story this week is earnings. Tesla, Alphabet, and Intel are all set to report, and those results could set the tone for the rest of the season. Neither buyers nor sellers could establish clear control today. It was a cautious, wait-and-see kind of session ahead of those big reports. Now let's move to the other 2 major indices. The NASDAQ Composite, which is heavily weighted toward technology and growth stocks, lost 0.05% today, closing at 25,508. The tech sector was a mixed bag. The NASDAQ came in ahead of the S&P 500 today, and that relationship matters. When the NASDAQ leads, it usually means risk appetite is strong and investors are favoring growth. When it lags, it can be a warning sign that the rally is narrowing. Today, the NASDAQ led, which is exactly what bulls want to see. The NASDAQ has been under pressure recently, and today's move was relatively contained. Moving to the Dow Jones Industrial Average, it finished lower by 0.59% at 51,839. The Dow underperformed the S&P today. Remember, the Dow only tracks 30 blue-chip stocks, and it's price-weighted, not market cap-weighted. That means a high-priced stock like Goldman Sachs or United Health can move the Dow more than a lower-priced stock, regardless of company size. The old economy names in the Dow struggled today. The key takeaway from the indices: all 3 are moving in the same direction, which shows broad conviction in the market. Now let's get into the sector breakdown. This is one of the most important parts of the show because it tells you exactly where the money is flowing. Today, 3 of 11 sectors finished in the green and 8 in the red. Most sectors were red. This was a risk-off day, leading all 11 sectors. Energy up 0.5%. In second place, communication at plus 0.14%. Third, technology at plus 0.07%. These top 3 sectors are where institutional money was flowing today. The middle of the pack, financials minus 0.39%, consumer staples minus 0.39%, real estate minus 0.42%, and utilities at minus 0.51%. Now the laggards. Consumer disc came in at minus 0.72%. Industrials at minus 0.72%. Materials at minus 0.99%. And bringing up the rear, healthcare finishing down 1.1%. The spread between the best and worst sector today is 1.6 percentage points. A relatively tight spread, meaning sectors moved mostly together. Defensive sectors showing relative strength. That can be a sign of late cycle positioning or general risk aversion. I always say, follow the sectors. They tell you the story before the headline does. Now let's look at today's biggest movers in the megacap space, starting with the number one gainer. Microsoft, ticker Microsoft, climbed 2.15% today, closing at $402.29. For a megacap stock, a 2.1% move in a single day is significant. We're talking about billions of dollars in market cap change. Microsoft continues to benefit from its massive AI infrastructure investments. And with big tech earnings season kicking off this week, investors are positioning ahead of results. The broader theme today was a rotation into chip and tech names. Intel gained 2.1%, Broadcom nearly 2%, and AMD 1.6%. The entire semiconductor space was recovering from last week's steep sell-off, when concerns about AI's impact on electronic design automation tools hammered names like Cadence and Synopsys. Today felt like a buy-the-dip trade in chips. If you own Microsoft, congratulations on a great day. If you don't, the question is whether this move has more room to run or if it's already priced in. Rounding out the top 5 gainers. Number 2, Intel, up 2.1%, closing at $97.06. Number 3, Broadcom, up 2%, closing at $378.16. Number 4, Salesforce, up 1.8%, closing at $173.79. Number 5, AMD, up 1.6%, closing at $503.57. All solid moves in green. Notice something here. These winners are spread across different sectors, which is a healthy sign of broad-based strength. Now let's flip to the other side. The biggest loser today, Oracle, ticker Oracle, dropping 3.98% to $121.38. A decline like this in a major name always raises the question, is this a buying opportunity or the start of something worse? Here's how I think about it. Context matters. One bad day does not make a trend. What you want to check is, has anything changed fundamentally? If the business is the same as yesterday, a down day might be noise. But if you see follow-through selling tomorrow, especially on increasing volume, that's when you should start paying closer attention. The rest of today's biggest decliners. Tesla dropped 3% to $369.57. Eli Lilly dropped 2.7% to $1,146.90. Merck dropped 2.4% to $124.40. Apple dropped 2.1% to $326.59. The average decline among our bottom 5 is 2.8%. Significant selling pressure in these names. Something is spooking investors. Selling pressure was concentrated in a few names rather than being broad-based, which is actually a healthier sign for the overall market. As I always say, a down day is not a disaster. It's part of the natural rhythm of markets. Every stock in history, even the best performers over the long run, has had days like this. The key is understanding whether anything has fundamentally changed and whether the thesis for these companies still holds. Time for our stock of the day segment. Today, that honor goes to Oracle, ticker Oracle. Let's put this stock under the microscope. Oracle dropped 4% today, closing at $121.38. Now let's zoom out and look at the bigger picture. Over the last 30 trading days, the stock has ranged from a low of $121.38 all the way up to a high of $174.46. That's a 44% trading range in just 1 month, which tells you there is serious volatility in this name. Traders love it, but it can be nerve-wracking for long-term holders. At today's close, the stock sits 0% above its 30-day low. The stock has room to run before it hits its recent high, which could act as a target for technical traders. This was the single biggest mover in our entire megacap watch list today. I chose it as stock of the day because when a name this size makes a move this big, it tells you something about the overall market sentiment and what type of stocks investors are favoring. If you're a long-term investor, days like this are noise. What matters is the quarterly and yearly trend. If you're a short-term trader, this kind of volatility creates opportunity. But as always, this is not a buy or sell recommendation. It's just data and context. Do your own research or talk to a licensed financial advisor before making any investment decisions. Now, let's pull up the macro dashboard. This is where we check the pulse of the broader financial system. First up, the VIX. Wall Street's fear gauge closed at 18.6, falling 0.6% today. That puts the VIX between 15 and 20, a healthy normal range. Despite 9 days of U.S. strikes on Iran, the VIX hasn't spiked. That tells you the market is not panicking. It's cautious, but not fearful. That's an important distinction. Next, the bond market. The 10-year Treasury yield rose to 4.6%, up from 4.54% on Friday. Yields are climbing again as oil-driven inflation concerns offset the cooler CPI data from last week. Above 4.5%, yields put real pressure on growth and tech stocks. Gold was essentially flat at $4,012 per ounce. You'd expect gold to rally during geopolitical tensions, but the rising yield environment is capping the upside. Higher yields make bonds more attractive relative to gold, which pays no interest. Crude oil sat at $82.42 per barrel, roughly flat on the day, but still elevated from the Iran tensions. The Houthi maritime embargo on Saudi Arabia is a new wild card. If shipping routes get disrupted, oil could spike further and reignite inflation fears. Putting it all together, the macro picture is tense. Geopolitics, rising yields, and a massive earnings week ahead. Stay sharp. All right, let's close out with my watch list for tomorrow. These are the 3 things I'm tracking most closely heading into the next trading session. Pay attention, because this is where you get your edge for tomorrow. Number 1, Tesla and Alphabet report earnings this week. These are 2 of the most important reports of the entire season. If they beat, this market rips higher. If they miss, the selling could accelerate fast. Number 2, the Iran situation is fluid. 9 days of U.S. strikes, and now a Houthi embargo on Saudi shipping. Any escalation could send oil above $85, which would be a problem for inflation and for stocks. Number 3, Treasury yields are at 4.6% and climbing. Any further rise could trigger a sell-off in growth and tech. The bond market is the one to watch this week. These are the setups, the catalysts, and the risk factors that I think could move the market tomorrow. Write them down, set your alerts on these levels, and be ready when the opening bell rings. Preparation is the difference between reacting and anticipating. And that is your complete U.S. market wrap for Monday, July 20th. Today we covered the S&P 500, the NASDAQ, and the Dow Jones. We broke down all 11 sectors, went through the biggest movers both up and down, gave our stock of the day, Oracle, a full 30-day chart review, checked the macro dashboard with VIX, bonds, gold, and oil, and finished with 3 things to watch for tomorrow's session. If you found this valuable, please hit that subscribe button. Turn on a notification bell so you get these episodes every single trading day. Share this with someone who's trying to learn about the markets. Drop a comment below and let me know. Are you bullish or bearish heading into tomorrow? I read every single comment and try to respond to as many as I can. Remember, nothing in this video is financial advice. I'm just sharing data, analysis, and my perspective. Always do your own research or consult a licensed financial advisor before making investment decisions. I'll be back tomorrow with another full breakdown. Until then, invest smart, invest early, and invest consistently. This is Invest from Zero. Good night.